Let's start by understanding how's business doing, because we understand insurance is one of the sectors which has got tailwind because of what's happening in the environment. What are your thoughts there?
So there are two kinds of business that we are doing. One is the protection business. As you rightly mentioned, that is actually seeing a tailwind in the current environment, and we have been doing quite well there. The other side of business is the savings piece. There again, there are two parts to the savings piece. One is the traditional piece that actually is growing for us. The other is the ULIP piece, which has been adversely impacted because of market volatility. But then again, that is something which is an industry phenomenon.
Right, Manish, talk to us about how the flows have been to your schemes, because you have got a wide variety of products, protection, ULIP, etc. Also, how has your overall asset under management grown? We understand it's knocking on just a couple of say $2 to $3 billion shy of 2 lakh crore overall. Talk to us about how that part of the business is.
So as far as the flows are concerned, as I said, there is a piece in the savings business which has seen a tailwind, which is actually positively impacting the flows. On the other side, there is another piece which has been adversely impacted, but then because of that, the net positive flows may have come off, but yet the flows remain positive. On the other side, what has also happened is because of the fall in the markets in the months of March and April, we had a considerable drop in the surrenders. So because of that, actually the net accretion to AUM has been pretty healthy for us. So in a way, the flows have been quite healthy for us. In terms of asset allocation choices that the investors are making, interestingly, what we noticed was that in the month of March, when the markets had fallen, there was a preference towards equities as an asset class, and naturally so. Now that the markets have rallied, so we are seeing some kind of choice or preference for the debt as an asset class. In terms of assets under management, it has grown smartly in the last 4 months or so in the current fiscal. So we ended the year of March 2020 at about a little over 1.5 lakh crores. As I'm talking to you today, we are at about 1.75 lakhs crores.
Right, Manish, talk to us about how are you observing the high frequency indicators as far as the economy is concerned. There is a naysayers are saying that this rally is not backed by fundamentals. There is disconnect between the Wall Street as well as the real world, the Dalal Street and the real world is concerned. How are you really reading the nature of the recovery going forward?
So as far as the economy is concerned, if we look back in time, I think the first half of the June quarter was significantly impacted because of the lockdown. But ever since the economy started opening up, we have seen a gradual improvement in demand trends across all sectors. It started with personal mobility. It has moved on to consumer durables, appliances, since people have been working out of home, so there has been a preference for buying televisions, washing machines, dishwashers, and so forth. So there are sectors which have been seeing certain tailwinds, and that has actually been spreading to more and more sectors. At the same time, there have been certain sectors like retail, airlines, hospitality, which have been adversely impacted, and there I would say it will take some time before those sectors really come back on track. But overall, if you look at the general direction of the economy, it is actually trending up, but after falling quite significantly in the months of March and April.
Sure. So Manish, with these factors on the table, were you surprised at the pace of the recovery? In March, people were just writing off the capital markets, and now they're appalled at the speed at which things have really recovered in the market. And also your take on the valuations in the market right now.
So, of course, I would like to confess at the outset that the strength of the market rally has surprised all of us. And it has happened not just in India, but also globally. And one of the reasons why the rally derives a lot of strength is the kind of liquidity injection that was done by all central bankers, specifically the US Fed, and followed by other European as well as Japanese central banks. Even in India, RBI has done a lot to improve liquidity in the banking system. So overall, it has been a rally led by liquidity initially, but followed by a series of improving narratives. So in a way, a bit of a positive surprise, but at the same time, it will go a long way in building the confidence of the investors that whenever things are down, that is actually an opportunity in hindsight, and one should not really be fearful of buying into the markets when they correct like they corrected in the month of March.
Manish, talk to us about your own portfolio positioning right now. How are you factoring in your hypothesis of this recovery and earnings as well from here on?
So luckily, we have been on the right side of this rally, and when actually we saw disruption in the month of April because of the lockdown, we realized that the market will not really have numbers to look forward to as support. Instead, the markets will rely on narratives. And if you look at the last 4 months, almost every month we have been having new narratives. So when markets were falling in March, the narrative was to go into defensives like consumer and pharma. From there, we moved to personal mobility, consumer durables, and so forth. Of late, it has been commodities. So in an environment of rapidly changing narratives, given the fact that we are managing fairly large size portfolios, we thought that it would be wise to avoid major sectoral deviations. And therefore, what we did was that instead of taking any significant sectoral calls, almost 85 to 90% of our portfolio, we said we will run closer to the sector weights in the respective benchmarks. Having said that, what we also did was we said that this is a time where we must focus more on balance sheet rather than P&L. And therefore, we said, let us be in either sector leaders or in companies which have good balance sheets and those that can manage to tide over this crisis in a better fashion. At the same time, what we also did was we said, let us reserve 10 to 15% of the portfolio, and that was left entirely to the comfort of the individual fund managers to invest in those companies where the sectors may have been adversely impacted by COVID, but those companies are expected to come out stronger post-COVID. So that is the way we have ran our equity strategy. On the fixed income side, and I think given the fact that almost 60% of our money is in fixed income, I think it's very important to discuss that aspect as well. We actually have done very well. It has been an extremely pristine portfolio with almost 94% of the portfolio invested in either AAA or in sovereign securities. In fact, it gives me immense pleasure in informing the audience that in our 2-decade history, there has been not even a single instance of any NPAs in the portfolio. So there, initially, when the markets fell, we actually went high on duration. And at the same time, in the month of April, May, when there was a mutual fund debt crisis, we took that as an opportunity to buy into certain corporate bonds of high rating, which were available at good yields and also at good spreads. So in a way, we actually took advantage of that kind of turbulence which existed in the fixed income markets, and quite happy about how we have fared in the last few months.
Manish, in fact, I must congratulate you the way you have been running your fixed income side of the portfolio as well. No casualty for there at all. Whereas at one point in time, the entire sector got badly shaken. What's your outlook from here on factors which will depend on this side of the business? Interest rates. How do you assess the liquidity? Do you see strain in the system still? What are your thoughts there?
So first of all, given the fact that we have access to really long-term funds, so liquidity has never been a problem for us. In fact, our liquidity conditions were very, very comfortable, even in the months of March and April, when several other houses were having those liquidity challenges. As on date, uh, given the fact that we have seen a smart rally in the government as well as corporate bonds, and also thanks to RBI action, the spreads for the corporate bonds have come off. So we have chosen to take some profits in the corporate bonds side, and we have moved that money to the government bonds because the spreads between government bonds and corporate bonds have narrowed. At the same time, looking at the inflation numbers, we feel that at least in the short term, most of the rally in the corporate bond market is over. And therefore, we have also chosen to reduce the duration and move the duration to close to between 5 and 5.5 years, which is again the benchmark duration. So in a way, we have taken advantage of the rally, and now we have moved our portfolio closer to the benchmark while maintaining the quality strengths.
Now that this furious rally has actually taken place, not only in India but even globally, what are the risks which you have on your screen right now in terms of being cognizant of what are the bumps which may lie ahead? Our investors and the viewers who are watching this should be cognizant of the risk at the horizon, at least, if not completely pronounced, but at least which may actually turn out to be a reasonable amount of risk.
So since we are talking of global markets and any risks emanating from that, so one clear risk to me right now, as I see it, is the upcoming US elections. Now, we have seen that in the medium term, whatever happens in the US elections, or for that matter, even in the Indian elections, market eventually takes its own course. But at the same time, we have also seen that around the election outcomes, markets tend to become quite volatile. So given the fact that we have got a very significant coming up there in early November, I think market participants should be cognizant of that. And then another factor that we should be cognizant of that is that while we are seeing a gradual improvement in the trajectory of demand both in India as well as globally, it would be naive to think that we are completely out of the woods, and therefore it's good to be a little contained in optimism. So while we are optimistic from a medium-term perspective, it is important to be very balanced in approach as far as investing paradigm is.
Manish, my last question to you, someone who is watching the show right now, a moderate risk appetite investor, what kind of asset allocation would you recommend or advise to be taken in the portfolio if one has a 1 to 2 year plus kind of a horizon?
There is no one right answer to this, Ajay, because asset allocation is actually going to be should be a function of a lot of things. One is age, the other is the overall earning capacity, and third is your overall goals that you seek to achieve. But there are three messages that we typically part with any investor. One is that invest in a combination of equity and debt rather than trying to invest only in equity or only in debt. So it's good to spread yourself across multiple asset classes. That's point number one. Second, it is extremely important to stay focused on asset allocation, and that should be independent of the levels of the market. It should also be independent of the views on the market. And the third and a very important one is that instead of trying to manage your portfolios for short-term returns, I think it is extremely important to do goal-based investing and keep doing it systematically. These are the three important messages that we normally like to give for our investors.
All right, Manish, on that note, we'll let you go. Thanks so much for joining us on the show today, and look forward to having you more often on the channel from here on.